We live in interesting times, don't we? And by interesting, what I mean is times when the past is no longer a good predictor of the present or the future, indeed. I mean, look at today's sell-off that began in Asia and which continued here in Europe. Or what happened, 18 days ago when the markets launched themselves into a stage jump and the crowd disappeared. Under normal circumstances, the good scenario would prevail. And what is a good scenario? That at long last we're seeing some wage growth, especially in the United States. This is going to put upward pressure on interest rates. Bond yields are going to go up. As bond yields go up, the price of bonds is going to go down. Quantity demanded of bonds is going to increase. There will be a capital shift from equities to bonds, and therefore there's going to be a correction. So all is good in the best of all possible worlds. This is not, unfortunately, what is happening. Or at least, I don't think it is. If you can convince me that we have a normal standard correction, I'll be a very happy person here in Berlin. For many years now, we have been witnessing an aberration, a weird correlation between the price of equities and the price of bonds. And I very much fear that this correlation is going to continue during the downturn as well as it was continuing during the upturn. And the reason is, fund managers will tell you this, there are a lot of people out there holding portfolio laden with bonds that yield negative rates. So when you have that kind of portfolio and the price of bonds comes down, there is a very heavy chance that there's going to be a sell-off. So those of you who suffered economics, microeconomics in college or in the universities that you attended, you'll remember the Giffen good, a good whose price goes down at the same time as demand goes down. And if this happens, the great worry, bringing my discussion, my talk to Europe now, the great worry is that if this happens, the European peripheries, fragile banks, are going to be in serious trouble. Because what keeps them going is the repo market, liquidity coming out of repos. So if those bonds begin to disappear from those portfolio that are now providing liquidity to, let's say, Italian banks, we are going to have a major squeeze at the time when the single supervisory mechanism of the European Central Bank is already putting a different kind of regulatory pressure on those banks, for instance, with non-performing loans. And there is the talk in town, not this town, a bit further south in Frankfurt, of the winding down of the quantitative easing program, which is keeping Italian public debt and Italian banks afloat. Speaking of the European Central Bank, it's quite interesting and quite worrying to read the minutes of the last meeting of its executive board, when they are talking about the probability of outcomes shifting towards the downside, and what they are particularly worried about is a combination of a rising euro, a hard euro, and increasing volatility. Because let's face it, in the last decade, the Eurozone suffered perhaps not a Great Depression, but a large depression. My country suffered a Great Depression. It is still in a Great Depression. But we had a serious depression here in Europe. And in an attempt to restore something out of it, the financial engineering was complicated. But the idea was really very simple. Through QE, push the euro down, and at the same time, make it safe for investors to invest in the Eurozone, both in the private and the public sector. That was the strategy behind QE, really. Now there is a great deal of talk and celebration of the recovery in the Eurozone. And there is no doubt that there is a strong secular recovery in the Eurozone. But it is important, I think, to take a closer look at events leading to this recovery and at the nature of this recovery. Now, when we discovered, well, some of us knew it before that, we discovered that the Eurozone architecture was very flimsy, and it was as if we had created a system that was designed to produce a death embrace between insolvent banks and insolvent states, the reaction, you know what the reaction was. It was a combination of extending and pretending, what I call an exercise in fraudulent bankruptcy concealment. Take the Greek bailout, for instance. Take, the LTRO programs of the ECB. That's what it was. It was trying to cover up, extending and pretending a bankruptcy, hoping that it will be resolved somehow in the future. With fiscal consolidation, or as we know it in everyday language, very serious degrees of austerity, not just in the periphery, but also in countries like Germany, where you have a significant surplus, while at the very same time, there are large swathes of this country that are condemned to underinvestment in infrastructure, in social protection, and so on. Now, this combination of socialism for the financial sector, allow me to say, with, harsh austerity for everyone else. One of the few things we economists know is that if you push the budget deficit to zero, and indeed to a surplus position, in an environment, in a money market environment, where there is a substantial excess of savings over investment, it's a tautology. This is not a theory. It is a tautology that you're going to end up with a very large current account surplus. So whereas in 2010, 2011, the Eurozone had a more or less balanced current account, today we have something like 400 billion euros worth of a current account surplus. In a sense, Europe is contributing to the destabilization of the rest of global capitalism. But of course, we Europeans, we don't care about it. But we do care about Europe. We should care about Europe. We have no right not to care about our own neck of the woods. The combination of the collapsing imports of countries like Italy, Spain, Greece, and the excess savings in the surplus countries like Germany, like Holland, like Austria, drove this current account surplus. Now, in this country, the government, I know that, I've heard this in my ear from the German finance minister, it is not our job to manage global demand or Eurozone aggregate demand. That is the line that one gets, which of course is completely understandable, even if it is inevitable that the response to this is, maybe you don't think it is your job to manage aggregate demand in your neck of the woods, in your neighborhood, outside your borders, but then if you do not manage aggregate demand, you are going to end up having to finance the bailouts that are an inevitability when the bubbles burst caused by the outflows of capital from Frankfurt to the rest of the Eurozone. And I would say it is also your job to invest in the infrastructure that this country needs so that political monsters like the Alternative für Deutschland do not rise up. But that's not for me. I'm not a German politician. This is for Germany's political elite to decide amongst themselves. Now, going back to the effect of quantitative easing, which was essential for the recovery that we now observe. If you think about it carefully, quantitative easing, which began, if you remember, in March 2015, but it was foreshadowed and therefore factored in the markets since the famous Mario Draghi speech in London in the early summer of 2012, the "I will do whatever it takes to save the euro" speech. Effectively, what this combination of that great pronouncement and QE did was to make it again safe to invest in the Eurozone, in public debt, in private assets, here in the heart of Europe. It made it safe. But ladies and gentlemen, I'm going to put forward the hypothesis that it did not make it profitable. Safe and profitable are not the same thing. If you look at the outflow and inflow of capital and treat the Eurozone as a single economy, which you should actually for macroeconomic and macro-financial purposes, you'll find that since 2014, there was a 1 trillion euro outflow from the Eurozone that went into the bond market in the rest of the world. At the same time, non-Europeans since 2015 have ceased, completely gone on a strike. They have not been purchasing fresh Eurozone or European assets. Within the Eurozone, we have experienced considerable asset price inflation as a result of QE, which, of course, you don't need me to tell you that, engenders a great deal of zombie corporations and initiates share buybacks that push prices of equities up artificially while depressing interest rates and therefore seriously angering the proverbial Schwabian housewife who abandons increasingly Angela Merkel, with the result that you have this very interesting contradiction of a country where everybody is in surplus. The federal government, corporations, and households, and still the political establishment, the two main parties, or three main parties, are crumbling and in a state of crisis. That is the reason which is underlying it. The mishandling, mismanagement of Europe's depression by means of a combination of financial and fiscal policies that acted as cortisone on a cancer patient, if you allow me a vulgar metaphor. There is a recovery. But look at the composition in the national accounts of our great European countries of that recovery. It is coming out of consumer spending, substantial increase in consumer spending, and net exports. If you look at fixed capital formation in the Eurozone, it is stagnant. So this is a recovery based on consumer spending, private debt. Look at Spain. The vast proportion of Spain's very fast recovery is due to an increase in the same category that gave rise to the bubble that burst, pushing Spain in that hole. And that category is, of course, private debt. Similarly in Ireland, look at the level of private debt rising. Another boom and bust cycle is in the offing. Is this the kind of recovery that we want, by which to get out of the depression of the last 10 years? I submit to you that it isn't. It is a kind of recovery which, lacking investment in the things that our societies need, and which would boost productivity, which is not rising. Let us not make the mistake of confusing competitiveness with productivity. Competitiveness is a zero-sum game. Productivity is a variable-sum game. It is productivity we should be aiming at, but we are not going to get it without investment. We can get competitiveness through a race to the bottom in terms of wages and in terms of conditions, but we are never going to get productivity through this. So you have, on the political balance sheet, you have the repercussions of stagnant fixed capital formation that are low-quality jobs in the leading countries of Europe, exceedingly high unemployment in my country and in other such countries like Italy, a substantial increase in the percentage of the workforce which is precariously employed and therefore cannot make long-term plans that would entail some kind of increase in spending on durables, on houses, on education, on investment, in human capital. And you have pension funds in countries like Germany being absolutely annihilated by the very low interest rates. And that is toxifying our politics and poisoning our democracies. It is not the refugees. The refugees, the other, the foreigner, whether he's a Syrian or a Jew or a Greek or a Portuguese, is always the other that is targeted during periods of macroeconomic, deflationary forces and mismanagement. Now, on the economic balance sheet of this recovery, I'm afraid it is not sustainable. It is not sustainable because, firstly, as I said before, it is predicated upon an increase in private debt, an increase which was the reason why we had serious problems in countries like Spain and Ireland. And at the same time, it is predicated on maintaining a value of the euro, squeezing it below its equilibrium level, equilibrium given the current account situation, something that I don't believe that the European Central Bank can continue to do. Because the European Central Bank is caught between a rock and a hard place. The rock, on the one hand, is the great pressure from the surplus countries to wind down QE, because QE is destroying the pension funds and it is creating political problems in the surplus countries. And the hard place, which is that the wind down of QE is going to push the euro up and undo the recovery that now everybody is celebrating, even those who are asking for the wind down of QE. Now, QE has to be wound down because QE has not succeeded in producing a sustainable recovery. But to call for its winding down without replacing it with a genuinely therapeutic policy is the height of irresponsibility, you will allow me to say. Now, it is clear that we need reform in our institutions, in our policies, at the central level. We have, in the Eurozone, we have countries with fiscal space, but with nothing really to invest in because the demand for investment is very low. And then we have countries with no fiscal space and great deal of investment funding demand, but demand that goes unnoticed or neglected. And we have no way of centrally recycling surpluses and deficits in a way that we can have equilibrium in the area or in the space of fiscal policy and in the money markets and the investment markets. This is a political failure. It's an institutional failure of the European Union. And what causes me a modicum of despair, I should say, is when I read the great and the good texts and proposals on how to overcome this problem. You know that President Emmanuel Macron has tabled several proposals about a common budget, effectively what I call a federation light, which will be so light that it will be macroeconomically significant, and which has already been rejected by both the CDU and the SPD in this country, even though they would like to adorn this rejection with very kind words for Emmanuel. Yeah? And then I read the more technical texts of the proposed solutions to the institutional dearth or to the institutional malignancies of this country. And that is when, thankfully I don't have much hair because I would have lost it when I read, every time I read these reports. It is, if you want, these are texts that should be taught in the best business schools, economics departments, as well as within corporate training programs, as how not to do things. Now listen to this. That least the one proposal where it seems that both the French elites and the German elites are converging. They are agreeing. Miracle, they've agreed on something. And they've agreed on the following. They realize that it is a problem not to have a safe asset that the banking system can use as collateral in the repo market, in all sorts of different operations. That's correct. We always lacked a European safe asset. So what do? They take the two most toxic financial instruments and they suggest that these are combined to produce a safe asset. What are the two most toxic of the last decade financial instruments? CDOs and sovereign bonds of Eurozone member states. We have this very interesting arrangement in the Eurozone where we have a central bank without a state to have its back, and we have states without a central bank to have their back. So we have sovereign bonds, which you know very well what they almost did to Europe in 2010, beginning with my country, the domino effect. And we have a CDO idea. So ISBs, European Safe Bond, is the talk of the town, and this is the great solution that is being touted. I'm only mentioning it because it is as if our both technocrats and politicians were not around in the last 10 years. That they missed what happened in the last 10 years. Allow me to read, I've written something down here from one of those texts that proposes the European safe bonds. It says, safety will be achieved by some combination of diversification and seniority. and financial intermediaries will be purchasing, listen to this, standardized portfolio of synthesized bonds. A bit like the Bourbons, who forgot nothing and learned nothing. A combination of CDOs and unsafe assets will never produce a safe asset. Now, there may be interesting innovations if we had other really hardcore safe assets. Let's face it. Mario Draghi's quantitative easing program created a synthetic but rock-solid proxy for Eurobonds. The bonds that are now on the books of the European Central Bank constitute as a body a safe asset simply because the Central Bank is behind it. It is the reason why we have stabilization in the Eurozone, why the Euro still exists, is this body of bonds. If this is wound down without something to replace it that will restore the equilibrium in the money market and in particular between savings and investment, we are going to have a situation where simultaneously the repo market will be hit, Italian sovereign bonds are going to suffer, and fragile banks throughout the periphery, and some of them in the center, in the metropolis, if you want, of the Eurozone, are going to be in trouble. So there is no doubt that we need to think very carefully about how we're going to go back to a dynamic macroeconomic equilibrium in the Eurozone. We have not done that. To have a dynamic equilibrium, we need to have a serious reduction in the Eurozone's current account surplus, which may involve an appreciation of the euro. We need to wind down quantitative easing because of the ill effects it has on our politics, on the pension funds, on the distortions in the equity market. But at the same time, we need, at the political level, and now I'm speaking as something of a politician, we need to end this stale and arid debate between the two camps, call them France and call them Germany, for heuristic purposes, of the liquidationists on the one hand and the integrationists on the other hand. By liquidationists, I mean the economists and politicians who are promoting as a solution to the architectural problems of the Eurozone mechanism by which to bail in investors, to bail in even deposit holders in banks, think Cyprus. Effectively, the liquidationist approach of President Hoover in 1929, if a bubble burst, liquidate it. Now, as a Greek and a former finance minister, I wish we had applied that in 2010 in Greece. I wish that our great and good, both in Athens and in Washington, the IMF, and in Brussels and in Frankfurt, had said, the Greek state is bankrupt, let's accept it, let's embrace its bankruptcy, let's not extend and pretend its bankruptcy by means of the largest loan in the history. But when you do that, you have to have mechanisms by which to absorb the shocks from the liquidation. So the integrationists, usually the French, who are arguing for a common budget, for fiscal mechanism by which to recycle surpluses and deficits, they have a point. What we need is a combination of a means of effectively declaring bankruptcy and embracing it, while at the same time integrating our fiscal capacities and our investment plans across Europe in order to make sure that the liquidation does not lead to what happened after 1929 in the United States of America. So allow me to finish with what I think is the way to proceed. Yes, QE must be wound down, but it must be replaced by a new policy for boosting investment directly. And how can we do this? Through an alliance of one of the most sterling institutions we have. I don't mean pound sterling, I mean brilliant. The European Investment Bank and the European Central Bank. Because you know what? We actually have a real Eurobond, the bonds of the European Investment Bank. What we need is a lot more of them, with Mario Draghi or whoever replaces him to be standing behind them in the secondary markets, and by which to fund a European recovery and green investment program to the tune of something like 5% of GDP, say 500 billion, across Europe, in order to take the excess liquidity which is causing all the deflationary forces within Europe and put it directly into the investments that Germany needs, Italy needs, we all need. Today I read that several cities, quite wisely, in this country are considering a ban on diesel cars. Well, how about investing into a massive switch from diesel to electric cars here in Germany? Something that, unfortunately, the car makers in this country have not done themselves. How about creating, at long last, the green energy union that we need in order, firstly, to have green energy, and secondly, to decouple ourselves and free ourselves, emancipate ourselves from Vladimir Putin. These are all things that are crying out to be done. The liquidity is there. We have something like 3 trillion euros doing nothing, or actually doing all the wrong things, as they are slushing around in the financial sector. It is simply a question of pushing it into the road that leads to the investments that can recalibrate and re-equilibrate our macroeconomics on this continent. If we are not doing it, we're not doing it because of a substantial political failure at the level of politics, which then feeds into political monsters in all our countries. Every single election in Europe these days, whether it happens in Austria, in France, in Greece, or in Germany, for that matter, is creating paralysis, it is creating discontent, and it is pushing good, intelligent Europeans to believe that there can be no solution from our political systems. Nothing contributes more to hopelessness and to toxic politics than that conviction. And now let me branch out away from Europe, or begin with the margins of Europe before going beyond Europe for a couple of minutes. One word: Brexit. What a disaster. On both sides. You have Michel Barnier, the chief negotiator of our European Union, who is not mandated to negotiate on anything that London needs. He's not, even if he wants to. Even if he wants to discuss what Theresa May wants to discuss regarding the substance of the long-term arrangements between the European Union and the United Kingdom, Barnier does not have the mandate to do this. He has a mandate to tick all the boxes on the form that he has been handed. Yeah? And you have a London government for which the national interest is the last thing on their radar screen. The only thing they care about is how to survive another day and how to manage this almighty civil war within the cabinet. A mutually advantageous agreement for the people of Britain and the people of Europe is not on the radar screen either of Brussels or of London. Another example of a massive political failure. I'll deal with Brexit very, very briefly. We have two options here. Everything else is noise. Either a WTO or at best a Canada agreement, which will be detrimental to the interests of both the peoples of the United Kingdom and the peoples of Europe, or a Norway-style agreement with several add-ons, which is what I have been trying to push Jeremy Corbyn towards. He seems to have accepted the customs union, which is too little, and I'm afraid it's going to prove too late. But it's better than nothing. And finally, just to finish off, Donald Trump. Now, how clever is it for an American president who is embarking upon the largest boost of the federal government budget deficit, at the very same time to be antagonizing and threatening with a trade war an entity that owns 1/3 of US Treasuries. I leave it to you there. I'm looking forward to receiving questions from the floor. Thank you.